Good afternoon, and welcome to today's episode of the Dairy Signal brought to you by Professional Dairy Producers. Before we dive in, we'd like to recognize our sponsor who helps make this program possible, Dairy Management Inc., your dairy checkoff funded by America's dairy farm families and dairy importers, is focused on growing sales and building trust in the dairy community. To learn more about how they're making every drop count, visit dairycheckoff.com, and a big thank you to DMI for your support. If you're joining us today for the first time, here's how you can participate in today's discussion. Look at the bottom right-hand corner of your screen and click on the three dots and select Ask a Question. You'll be prompted to add your name, but you're more than welcome to submit that anonymously. We'd love to hear from you and answer what's on your mind today. Today, we're diving into another market update, and we're pleased to be joined by Ben Buckner, Chief Grains and Dairy Analyst with Ag Resource Company. Ben, thank you so much for being here today, and I'll hand it over to you to get started.
Okay, thank you so much, Caitlin. Always a pleasure to be a part of the Dairy Signal. And we will just jump right into it. And I think from a very high level, want to communicate that I think it is time to start locking in some margins. I think from a very big picture, we don't see a lot of supply issues currently or forthcoming in either the dairy or the feed space. We've got some life in corn, soybean meal, soybeans this week. I don't know if lows are in, but at the same time, I think you can say that most often, especially in the last 15 years or so, lows in corn, at least in Chicago, have been posted by the end of August and soybeans by the end of September. So we want to think about, those current milk feed ratios, which are pretty attractive, but let's pass some of this risk off onto someone else. So that's a very high level message. But again, I think that sort of underneath the hood, it is the world's kind of awash in milk suddenly. And I think the big surprise has not been in the U.S., where we have seen this rapid growth in herd sizes, especially in places, along the spine of the U.S., Texas, Kansas, South Dakota. But Europe has surprised us as well. They are finding some yield gains and outright milk production gains, and so is New Zealand. So if you think about kind of philosophically, the last 4 or 5 years really been driven by supply dislocation. Dairy demand, very firm, doesn't really alternate or doesn't change from about 1 or 2% per year every single year. And so, 2 years ago, you had demand growth. No exporting country was producing more milk than they were the previous year. I think now those issues are being solved if they're not completely solved already. So it's a different marketplace. And I think the thing we are concerned about, and again, just to be very clear, is like normally sort of Q1 2026 and maybe into April or May. We have seen in the past class 3 with a 15 in front of that, even in the last 2 years. And so I think that is the big picture risk as we start to head into the autumn months. And the market's been, I think, trading appropriately. And this is all explained by fundamentals, where you've got periodic spikes. Cheese demand still very good. We know that butter demand does not really even get going until kind of September, October, November, the holiday baking season. But those rallies have lacked, follow through. And I think, generally speaking, very broadly, there's no need to ration available milk or dairy product supply. So keep that in the back of your head as you see recoveries in class 3. Think about hedges. Think about extending those hedges into, what is always the weakest time of year, and that's winter and early spring, when we just on a per day basis don't consume as much dairy. It's quickly followed by sort of peak production in the Northern Hemisphere. So to avoid that in 2026, I think will be difficult. But you can see here that chart resistance is still very much intact at about 18.5 basis October. So I think that is your target. And you can also see pretty clearly this structural downtrend that's been in place since the early part of summer. I think we're sliding into equilibrium here, but I don't think that this trend changes. I think the spark to change that would be some production hiccups in one of the exporting countries, but we just don't see that, really into the end of summer. So again, a lot of milk supplies are available in the U.S. and elsewhere. I think that will be reiterated in a matter of hours when the USDA publishes its July milk production report. There should not be any real surprises here. I think that we'll see production growth of 1.5 or 2%. Makes perfect sense. The market's fully prepared for this, but that will be the case. So just assuming let's say cow numbers expand by another 3 or 5,000 head. Let's say we keep intact this, 0.5% to 1% yield growth year over year. And you're kind of stuck with production both in July and probably in August of about 19.2 to 19.4 billion pounds. In very big picture, we've said this before on the dairy signal. If these bars, they keep this as simple as possible. If these bars are above zero, you're not in a bull market. If they're below zero, you typically are in a bull market. And you can see pretty clearly that, again, we are back to kind of pre-COVID levels of growth. Everything is normalized following, a 4-year disruption, but I think production growth in the US and elsewhere is back. So again, think about how markets behave. Is there a need to encourage production? Is there a need to ration available supplies? I don't think either of those are the case currently. And if this continues, and we'll touch on the world production numbers in just a bit, just think about what happens, you fast forward 3 or 6 months from now when you've got, a full year under our belts of, production growth globally of, 3%. It's going to look very much like it did prior to 2020. So that's, I think, the long-term risk, but we have some time and decent prices and margins to be prepared for that. And so that's the action that we'd like to take. What has changed in the last 2 weeks, since our last signal, is we did get the August WASDE, which was kind of a shock in the feed markets, and still something to think about when we think about physical pricing of corn, if you're a producer or if you are an end user. We'll touch on this too, thinking about corn production, and we'll continue to debate where exactly it ends up, but, it's going to be very high. And compare that against storage capacity. That's something we'll bring up in just a bit. But U.S. milk production rightly was increased another 900 million pounds in calendar year 2025. So now we're growing annually. And I think this is the case, given we've already got half of the year confirmed, about 1.5%. And so again, this kind of mirrors the monthly chart we saw previously in that we're just kind of back to pre-2021 levels. And so again, normalization is kind of the theme. Finally, we've solved a lot of the world's milk supply issues, and this probably, again, unless there is something majorly disrupted in the northern hemisphere, weather-wise, policy-wise, you can extend 1% or a billion bushel production gains into 2026. So again, we want to challenge everyone to think what markets look like 6-12 months from now. U.S. milk production and growth is back, but that's not really, I think, what we're concerned with or why the Class 3 market has struggled on rallies in the last couple of weeks. It's everywhere else. And so, even as the U.S. was expanding production, recovering cow numbers and herd sizes, we still had this, and we do today to some extent, but we still had, the highest share of world trade that we've had in a couple of decades. Again, that is still the case as of official data through June and probably continues into the middle part of autumn. But that might be changing 2026 onward, just as these competitors start to produce more milk. So you can see here that unlike the US, New Zealand and Europe have been challenged to grow milk production even in 2025 and 2024. But those places also seem to have normalized when we think about yield growth, herd or cow numbers, outright production totals. And thinking about, too, again, the fast forwarding is the theme of this meeting. New Zealand doesn't produce a lot of milk, July, August. Seasonally, it's very rigid, for all intents and purposes. They're almost producing close to zero, though they did produce, 260,000 tons in June. It's up 14.5% year over year. But their kind of recovery seasonally is forthcoming. So, you kind of step on the gas pedal in Oceania milk production starting in September. And that continues until about February or March of the next year. So if you do have higher production in New Zealand, Australia, Europe's been a big surprise, despite a lot of policy, weather challenges, feed market challenges, they're still able to produce, 1.5% to 2% more milk than they were last year. So the world, in totality will have, I think, ample or at least adequate supplies of milk to boost processing capacity. There will be products searching for demand in the global marketplace 90 days from now. And so what we have seen in the U.S. and what's really driven, milk feed ratios and outright milk prices and through a lot of 2025 exports. And I don't think that really goes away, but does it kind of stagnate in 2026? Another concern that we've got. But just wanted to, if there's anything to take away from this, is that New Zealand's producing more, and Europe surprisingly is producing more milk than they were a year ago, and that was unexpected 3 months ago. But here they are. Ireland just going gangbusters and producing things. So Kerrygold, et cetera. There's going to be an abundance of Western European butter available to the market at some point in the next couple of months. when we put it all together, we've known that U.S. milk production has been expanding now for several months. Europe is back. New Zealand is back. Again, that's kind of what we start this with. The most important feature when we see price recoveries and managing forward risk is just the world being adequately too oversupplied with raw milk. If we put Australia, New Zealand, Europe, and the U.S. together, production was 23.6 million tons in June, up 2.5% more or less year over year. That's the highest growth rate we've seen since really spring of 2021. So again, big picture, milk supply issues being solved. We're kind of running out of fuel maybe to spark rallies back to 20 or 21 class 3. You need some kind of disruption. We just don't think that disruption occurs for the rest of calendar year 2025. The fat market too has been a little surprising, but this is all part and parcel of having access to more raw milk in the United States. So there's been a lot of incentive to increase butter production, of course, having seen $3 plus cash prices the previous 3 autumns. A lot of money to be made, especially with milk prices being where they're at. And so we've seen butter production expand, almost every single month for the last 2.5 years. Production in June, which has been known for a while, but 185 million pounds, up 10% year over year. I just don't think there's a shortage of fat. I don't think that butter prices can drop below something like 220 or 230. World demand is very, very strong. But we can say, unlike the last 2 years, there is market balance. I think the supply and demand for fat and butter is the most balanced it's been in about 36 months. And if we look at butter seasonal trend, I think there was a bit of a squeeze, pre-holiday needs, end users having to sort out what is always record consumption during the autumn months. But that squeeze has come and gone. And so I do think we're kind of left with this pretty dull butter market. And like all years, probably a little bit of weakness during the winter, maybe the entirety of Q1 2026. I think that's when we may see 230, 225 cash prices. So class 4 also worth hedging, I think, out months, given where prices sit currently. And the October, the forward butter market's already kind of telling us that I think end users have sorted out any potential supply tightness ahead of and during the baking season. So that has come and gone. It's taken 3 years to learn this lesson. The first year was just an incredible spike from 250 to 350 per pound in butter in a matter of weeks. Last year's price was very elevated, slow but steady, but you can tell that people were a little more prepared for this. And I think the entirety of those lessons have been learned this year. And so people were already starting to prepare for September, October, and November needs, maybe as early as winter 24, 25. And that explains, I think, why the butter market's not been very exciting. Throw in higher production in New Zealand, the world's largest exporting country, and of course Ireland, who's become a very big exporter of butter, just having production growth for milk several consecutive months of 8 to 10%. So the butter market, no real supply issues like milk, no need to ration that product, and that's different than the last 2 years. However, I do think there is some silver lining to this, and I think that all milk cash prices will, one, sustain this $2 or $3 per hundredweight premium to the class 3 market. It's no longer based as much on fat demand or class 4 or butter prices, but you have these kind of lesser markets, the powder and whey markets, I think doing pretty well. And unlike looking at something like US or export of milk production or the butter balance sheet, the details of that per month, the whey and non-fat dry balance sheets have gotten very, very tight very, very quickly. None of this probably gets solved through the rest of the year. It's going to take until February or March of next year. So I suspect, cash whey nationally, it's on its way to 65 or 70 cents per pound. Already today, it's 58 cents quoted this week, was 49 cents a year ago in mid-August. And seasonal trends, which are pretty rigid, you can see those pretty clearly in the graphic on the left. So this is adding some support. There's still value in raw milk. And even for the next 30 days, I think, maybe 60, 75 days, there's not a lot of competition for something like cheese exports. The U.S. butter market is also priced to sell. I think we'll stay a net exporter of butter. So if you are an exporter or an end user, at 17.5 class 3, at least for the rest of this year, there's a lot of value in that. I think processors can make a lot of money at 17.5. So I don't think, the sky falls out, at least for the next 3 or 4 months. But again, it's 2026 that we're concerned about. Non-fat dry as well. quoted this week $1.41 per pound in the cash market, was $1.33 a year ago in mid-August, and probably on its way to something like $1.50, $1.55. So I think that kind of sorts out or replaces maybe the excitement of the fat market and the class 4 market. So I think cash prices, milk checks between now and at least the end of November will be 19 and a half, 20, 20 and a half. So silver lining, I think those are positive prices. And also thinking about cash corn at 340 or 350. I think to some extent this is as good as it was a year ago in the physical cash markets. But we do like locking in these margins. This is kind of what it looks like. So again, if we kind of can see the forward guidance, let's call it 17 and a half or $18, 18 and a half today for class 3 through the end of the year, that does give you a cash price very close to $20 per hundredweight. And I think maybe September could be 20 and a half or 21 in Wisconsin, kind of nationwide, a lot of the upper Midwest, especially the big producing states. And the USDA agrees with this. So they opted to, I think rightfully, kind of trim their butter price forecast for 2025, by 4 cents a pound, just adjusting for, even cash market action. We have seen, on a daily basis, cash butter trade nationally below 235 per pound. So they've got to do something. Other than that, kind of leaving everything alone, raising non-fat dry a little bit. And I do think that, especially since we've got, really 7 months of the calendar year behind us, several of those months we saw cash prices above $22 per hundredweight. I do think we're locked into a national average cash milk price in calendar year 2025, something like $22. Maybe it's 21, 30, 21 and a half, but I don't think there are any problems with the USDA's price forecast with respect to where it stands today. But it is the forward milk outlook that I think that we're concerned about. So you can see this upward trend, and this I think does give us hope for a pretty decently sized share of world trade almost indefinitely. Especially if U.S. dairy product markets break, I think that becomes more attractive to importers at least. We don't export a huge amount of our production, but that is where price is determined for most markets. At the same time, though, we have had this correction. I think the global butter and cheddar markets have been extracting premium, and that is probably all centered on the surprisingly large production numbers in places like New Zealand and Europe. So, global butter prices probably too expensive above 350. Today they're 324, at least according to the auction. And cheddar prices, too expensive above $2.20, but fairly priced somewhere close to $2 per pound. But I think it's the next 6 months that we are concerned about if these markets or the global auctions, bi-weekly price is largely set on kind of short-term Oceania supply and demand. I think that most likely loosens a bit over the next 6 months. So I think the global auction prices will move lower and over time. So we're kind of shrinking the spread between cheap US butter and cheese and the world market. It's not going to be as wide as it was, 3 months ago or a year or in early spring, from early spring to early summer, where we were incredibly cheap. So that's not going to be as exciting anymore. So the world market's getting cheaper. It's not getting more expensive. And then just normal seasonal trends. And I know these are pretty simple and maybe easy to dismiss when we get hyper-focused on what's happening this week or this month, but they tend to work in most of these raw material markets. And that's not even terribly insightful. I mean, futures are rooted in the physical supply and demand of these things, the cash price of these things. So we just have a lot more milk relative to consumption in the Q1 of any calendar year. We have the most corn. We have, September, October. That's why those seasonal trends are in place. So it is the sort of winter, spring months of 2026. Again, we want to be very clear. That's, I think, the risk to manage. And what I've done here is highlight, this is a spot CME Milk's monthly settlement since early 2017. The circled areas highlight April, kind of the Feb-April period of the last 5 years. And so it hasn't been everywhere, especially thinking about the incredible bull run of 2022. But otherwise, you can see it kind of corrects sometimes pretty sharply from about October, November into February and April. And I guess it's our job to determine or find something that would prevent that. What would change the structure of class 3 milk, given that's the most we are going to have relative to demand most years or almost any year anywhere. Is there something that'll disrupt that when we're talking about price discovery? And like I've said before, looking at foreign production, I don't think today we can identify that. We will keep a very close eye on trade deals, retaliatory tariffs, trade deals that specifically involve ag or specifically involve the monetary value of U.S. dairy exports. But today we can't identify something that prevents kind of a swelling or short-term ballooning of U.S. dairy product stocks. And that happens every year, Q1. Just be mindful of that as we start to get into the autumn months pretty quickly. So the outlook, and I still think, having said all of that, we're still fairly positive on the protein and fat space. Just like the last couple of dairy signals, it no longer centers on cash milk prices, but rather where does cash milk exist relative to input cost, I think is the thing, feed specifically. So even after having a drop in class 3 this week and some recovery to corn and soybean meal, we're still abnormally high in these milk to feed ratios. The forward markets are improved or a little better in corn and still very, very elevated in protein meal. So I think that this probably looks the same for the next 90 days. But also I think that we really like where these ratios exist today. And so without knowing the details of the future, trade deals, maybe the exact nuance surrounding U.S. corn yield potential or crush rates, biofuel policy, we like starting the process of hedging these and thinking about Jan, Feb, March of 2026. Kind of we'll close out this with looking at corn seasonal trend, which is still a little bearish, but kind of on its way to maybe a low. And milk, cheese, butter typically set highs in October. So this is the exact time of year, I think, to lock in those margins on a longer term basis. So think very, very hard about that. But to us, it's not even measuring the nuanced details of corn yield, corn supply and demand, or soybeans or soybean meal. I can't prove today that December corn has not already set its annual low. The debate will be whether December corn needs to go to something like 370, 385, 390. Maybe it stays at $4. That's less important to us than thinking about big picture physical supply, U.S. exporter and world balance sheets, and even what that probably looks like in 2026 if there is not a supply dislocation caused by weather. And so the insight that we want to sort of relay to people now is not that December corn is overvalued today, but it's probably that the corn, soybean meal, and even wheat markets are sliding into a period similar to what we saw between 2013 and 2020. So I think one of the consequences of having adequate to oversupplied markets, no big weather threats in either hemisphere, is you lose volatility. So most likely the corn outlook is, December or spot Chicago corn expires somewhere between 390 and 420 every month for the next 12 months. If there is not a weather issue in Brazil or Argentina between, let's call it October and March of 2026, you probably stay here. And do you stay here? I think now is the question. Is it 12 months? Is it 18 months? Is it 3 full years? I think that we're kind of stuck at these prices until there is a disruption to things. And that could come in the form of trade deals, but we think it's really down to weather adversity somewhere. It did not really happen in the Northern Hemisphere this year. And again, we can all debate where corn yields end up, but it's going to be a big crop. Does it happen in the Southern Hemisphere this winter and next spring? And even the early guidance we're getting, and we'll take Southern Hemisphere weather week by week, but it looks better than it has in a couple of years. And the smartest climate scientists in the room suggest this should be a pretty normal year for Southern Hemisphere weather. And so again, fast forwarding, that'll be the 4th crop cycle in a row that both hemispheres, the exporting countries in both hemispheres, have produced yields at or above trend. So just building stocks is kind of the theme, I think, in feed markets. We'll debate exactly where DC corn needs to be, but I don't think it needs to be terribly much higher than it is today, maybe not much lower, but I do think feed markets are stuck. Soy meal, similarly. Like 2016 to 2020, the fair value of soybean meal is probably between, $290, $320 a ton. And it's just stuck there. You lose volatility. That is equilibrium. And that stays equilibrium until something is disrupted. And for the protein meal market specifically, I think even that's the one market we might wait on corrections, let's call it $5 or $10 per ton before doing a lot in terms of coverage, because that is the one market I think that's very harder than corn or wheat or even soybeans to tighten up supply and demand. And this is all based on the kind of rapid and ongoing expansion in US soybean crush capacity, EPA guidance, of course, on renewable diesel and biodiesel production and consumption in 2026, which kind of sparked the market today. The Trump administration may announce what it does with small refinery waivers as early as tomorrow. And so a lot of rumors, whether that's a high number or a low number, will materially impact soybean oil prices. We don't know exactly what that will say, but given crush capacity where it stands now, crush margins are quite fancy in the cash market and futures markets, both up to 240 or 260 per bushel of soybeans crushed. So you can see here production in meal has been a record in each month since February 2025. Up between 5 and 10% cumulatively. We're up to 31.8 million tons according to NOPA data. It's up 5% year over year. I think that number gets even higher as we look into 2026. So there will be no shortage of protein meal. We all know it can't really be stored. It's got to go somewhere. So I think the meal market will occasionally experience what this week has been a short covering rally. If you look at funds short position in meal 2 weeks ago, it was absurdly expansive. That's being pared back today, but I do think the meal market will also at times in the next 6 and 12 months have to go to a price that finds demand. That seems to be about 260, 270 per ton. So thinking about Pro Farmer this year and really the sort of weight of the corn balance sheet, just the amount of physical supplies that will be available to is, the USDA kind of surprised us all in going to 189 bushels an acre national yield very quickly. So to some extent, I think price action can be explained the last 10 days by the car or the dog catching the car. So what do you do now since you've raised yield by almost 8 bushels per acre? And our tour of Illinois and Iowa last week, we tried to front run Pro Farmer just to go see what happens. Can you validate what the USDA tells us yield will be as of earlier the middle part of August? And what we found validated it almost exactly. So, of course, we were in the northern half of Illinois, all of Iowa, some of the wetter places we experienced this summer and where crop conditions, vegetation health is very, very high. And in fact, as of 10 days ago, was the highest it's ever been for early August. So you kind of see that provides kind of a proxy anywhere on a soil moisture map. And I assume, maybe arrogantly, but I assume a lot of Wisconsin will be similar, just very, very healthy fields. So I know we're not out of the woods just yet, but what jumped out to us was, populations. So we counted, on average in both states, 32,800 ears per acre. It's up 6% from our tour data a year ago. Kernels per ear, 674, up 4 from last year. And an ear to stalk ratio of 98%. That's the highest in the decade we've been doing this tour. So the ingredients for these really incredible yields do exist. And we put them together. So we kind of get into, let's just count, kernels per acre and put that against the final yield in Illinois and Iowa combined. And the USDA's combined yield today is projected at 222 bushels an acre, a record, I think, of 7 or 8 from last year. The red dot kind of puts these two together. So we counted 22.1 million kernels per acre. This is almost exactly aligned with the USDA's Illinois and Iowa corn yield forecast. So I don't think that they go up in yield anymore. And in fact, just kind of the basic math, once you go from 181 to 189, most likely, if anything, you're going down, even if just a little bit. But I do think what we found was, we wouldn't expect a big revision in the September national U.S. corn yield. So it's a very, very big crop. And even Pro Farmer this week has, I think, largely validated that. So I know Pro Farmer gets a lot of attention. And they do a lot of really good work. I mean, it's hard to replicate that many people taking that many samples. But the exact yield that they present, we care less about. We rather, since we've got history going back, a couple of decades, what is the year over year change in terms of percentage? And we can just kind of plot Pro Farmer's estimate against, the USDA September and final yields. These show the pro farmer to September USDA yield correlations for Illinois, Indiana, and Nebraska. Illinois may be 5 or 10 bushels too high. And I think that is what has dominated the sort of news cycle, maybe even price action in the last 24 hours is, where there is drought in kind of small pockets of Illinois, those crops aren't doing as well. So Illinois, they revise lower, 8 to 10 bushels an acre. That nationally could trim half a bushel to maybe a full bushel off of national yield. But when you think about, yield in Indiana, pro farmer was at 194, USDA's at 205, matches perfectly. Looks like NASA's right on the money in Indiana, Nebraska as well. So they found record populations, record yield potential. I think that's still very much intact. So anyway, that was a long-winded way of saying I wouldn't bet that NAS really changes its yield all that much. And the September reports was a very high yield. And even this week, this shows gauge measured rainfall since early Sunday. And not everyone got rain. There are still some concerning areas. I think Ohio, Kentucky, southern third of Illinois specifically. But a lot of places did get 2/10, 6/10, up to 3 inches of rain. And thinking about the concentration of corn acres on the Minnesota-Iowa border, those places pretty easily got between 1.5 to 3 inches of rain. So I think a lot of these crops, regional at least, are still getting bigger. And what we found too in Iowa and Western Illinois, at least, again, places that have been pretty wet. It's not excessively wet when we were touring, but it was kind of damp, moist. The agronomists that we were with say you probably just coast to the end at this point. There's not a lot of water needed. Additionally, and of course, we know that at this point, water demands from the crop pretty low. Peak demand is peaked. So, there are regional issues, but I think sort of the heaviest concentrated corn acres, soybeans as well, just fine. And again, I think the debate, which is fine to rage on, is do you even need any more water in a lot of places? And probably not. So this is what we think kind of in the end. I mean, we have no major disagreement with USDA. We have matched their yields based on what we found on our tour, and I think again what Pro Farmer is finding this week. But even the USDA's 2.1 billion bushel in stocks forecast totally aligned with the cash price below $4 per bushel. The problem that we've got is with some of the demand numbers, or at least that is the risk when we think about sort of subsequent USDA reports. Feed and residual needs to be higher. That is just a function of production. Bigger crops, more kernels to be lost. That all makes perfect sense. Ethanol, though, they've gone up, 130 million bushels year over year for crop year 25-26. Ethanol's demand draw. And that's, ethanol has been more or less subject to gasoline consumption. And I think that's pretty fair to analyze that way. And gasoline consumption has been mixed, but at least so far in calendar year 2025, pretty stagnant relative to the previous 2 years. So if you don't have significantly higher gasoline consumption, I think you're producing ethanol with no place to go, at least. So we are lower, a little less optimistic on new crop ethanol use. And exports, which have been doing very, very well. We are, I think total commitments for 25-26 U.S. corn exports, something like 660 million bushels. That's the highest in 5 years. But there is a lot of competition. So USDA's forecast, 2.9 billion bushels, the highest it's ever been. Starting out at that level is kind of alarming to us. To justify that number, you're going to have to see several more weeks where sales weekly are 100 million bushels or better. Again, it's been very, very strong so far. Can it continue? I think is the big question. But simply put, we think stocks may be closer to 2.5 or 2.6 billion bushels. That is a $3.50 average cash price. And here's what we think is, again, the risk. So Ukraine kind of locked in. They're going to have a crop that's up about 100 million bushels from last year. Total exporter production, excluding the United States or our competition, going to be up, almost 20 million tons or 15 million tons. A year ago, it was down 400 million bushels, and I think that's what funneled so much export demand to the United States and ultimately gave us $5 plus corn prices. But this year, our competitors in the calendar year 2025, Ukraine, Argentina, and Brazil, will produce 670, 690 million bushels more than they did a year ago. And I think even in Ukraine, once they start to harvest corn in October, I think that corn will be looking for a place to go. And their domestic use is pretty stagnant. So I don't know if we're quite out of the woods in terms of dominating corn market share. But that's not even really the insight. We can debate whether stocks are 2 billion bushels, 2.5 billion bushels. All of that kind of aligns with a $4 even market, and that's exactly where we are. But it's next year. So if we're carrying over 2.5 billion bushels or 2 billion bushels, and let us assume that because of the soy corn ratio, elevated fertilizer prices, cheap corn prices, we will lose or shift 6 million acres of corn into soybeans. Let's assume trend yield, probable, U.S. share of world trade, trends in ethanol, feed and residual use. And next year, if there is not a weather problem, you're still left with 2.2 or 2.3 billion bushels. That is still a $4 market. So now we're talking, 24 months in advance that there's just not a lot of need to ration corn supplies. It's adequately to oversupplied. What changes this, I think, is the game we all have to play over the next several months. Is it South American weather? Is it a Chinese trade deal? But if neither of those things disrupt supply and demand, just know that we're going to be adequately supplied in the feed markets, not this year, but also next year, maybe the year after that. So I think that is what's new, and that's what's jumped out to us since the August report. And then we're just not sure, again, that we've set lows just yet. And again, that debate will be ongoing. It is not impossible that December corn set us low already. But it's the domino that falls next. Is it cash supply movement? So assuming the USDA is correct, all crops combined from barley, sorghum, soybeans, wheat, canola, 23.5 billion bushels. And that will be 92% of storage capacity, at least capacity reported by USDA last December, which is more or less stagnated in the Midwest and nationally. That's not a level we've seen since 2016. And it's not 100% of storage capacity, but it does seem like there could be some regional stresses. What does the market look when you have harvested, 17.5 billion bushels of corn? Where do those extra bushels go? That's something that we're concerned about. Maybe it's the cash market that does the heavy lifting here. I just don't think that has run its course yet. When we think about Illinois and Iowa, having gone on our crop tour, validating USDA's forecast, that'll be about 97% of existing storage capacity in Illinois and Iowa. Also, something we haven't seen in many years. And so what does the market look like if that's the case? I just think that the need to clear excess inventories is, again, maybe not something that drives December corn to new lows, but does weigh on recovery efforts. I mean, we can't afford to lose any demand at all. Rallies will only serve to do that. We've got to stay competitive globally. Ethanol margins have to be maximized. So I think that, for the producer, we like selling rallies, but for the dairy operation, I think feed markets will work in your favor for a long time. We've also got the problem of Chinese soybean demand. I mean, to be very clear, China has yet to buy a single bushel of U.S. soybeans for delivery after September 1st. They have run out of outstanding sales, so haven't shipped anything in about 45 days. China is solely securing South American soybeans, and I think for political reasons, because soybeans are more expensive if you were to buy it from Argentina and Brazil compared to the Pacific Northwest in the U.S. They're doing it anyway. And so we're kind of starting to see this happen. So our soybean pod count was up. Our ear counts were up, 1,900 from last year. We're finding incredible pod numbers. And I think that's been one of the, not surprises, but maybe one of the new insights from the Pro Farmer Tour is, corn yields, maybe the USDA lowers, yield a bushel an acre or keeps it where it is, but it's soybeans that have upside risk. And we were counting certain plants in Iowa and Illinois that would have up to 128 or 130 pods per plant. Potential is there for just a massive crop. And so we're kind of starting to see that collide with the complete absence of China, and already some, organizations are writing letters to the Trump administration saying we need to get China back to our market, or the situation 6-12 months from now could be pretty dire, especially if there's not a South American weather threat this winter and next spring. And we're generally not kind of thawing the relationship. So now we're targeting a lot more imports from China because of labor issues with the Uyghurs. But it does seem like whether it's that, the certain chips that we are allowed to send to China, none of this is improving. There's no real plans to readdress trade issues with high-level Chinese counterparts until the middle of autumn. And so at that point, harvest will have more or less come and gone. And, that US Chinese trade deal in 2026 will be welcomed, of course, but it will occur after we're experiencing all these issues with storage capacity. So we are uncomfortable with where US Chinese negotiations are today. And some of the contacts we talked to say China might buy minimal amounts of US soybeans between now and what could be the return of Brazilian exports in the first part of February. So the window is getting smaller, and soybean demand is what we're concerned about as the market is going up. It's hard to replace China if they do not come to the US market. And again, that's our biggest concern. Corn, pretty easy to explain. It's been a supply-driven bear market. Just the acreage expansion was incredible. No major issues nationally, record yield potential, et cetera. But soybeans, maybe it's yield to some extent, but it's demand that we're concerned about. And so every week, we can count the vessels waiting at U.S. ports with soybeans on them or soon to load soybeans. And you can see here that it's pretty deflated. There are only about 250,000 tons of U.S. soybeans kind of scheduled to leave in the short term. And I've highlighted here the last U.S. trade war, which usually the lineup expands, explosively September and October. But is that going to be avoided because we're not selling beans to China? The alternative markets, think about Europe, the rest of Southeast Asia, cannot replace China. So you can kind of see here the deflated nature of U.S. physical soybean exports in 2018, 2019. Is that something that lies ahead of us? And nothing's really altered our ideas here. So if we exclude outstanding soybean sales from old crop positions, but just focus on what the exporter has sold specifically to all destinations for new crop delivery. And as of really today, it's only 215 million bushels. That's the smallest since 2019. Typically, because of the seasonal nature of the soybean market, we have two hemispheres that produce almost the same amount of stuff. So we alternate between when we're exporting and who we're exporting to. Typically, the U.S. soybean exporter will have committed about 50% of annual soybean shipments by the middle of October. Some time left, but again, the runway is getting smaller. It's not getting larger. And thinking about a year like 2019, trade war, final exports are only 1.68 billion bushels, and that is pretty decently below the USDA's current forecast. So is that something that the soybean market has to contend to? Just, again, from a big picture standpoint, Chinese demand does not exist for U.S. soybeans, and that is a concern to us. Because we've already lost probably September and the first part of October, just based on looking at vessels carrying soybeans out of Argentina and Brazil. And I think China has told us that they're buying South American beans for the first half of autumn already. They probably are forced to buy some amount of soybeans from the U.S., but you can see that we're kind of soon to miss our big window. This just shows the seasonality of U.S. soybean exports to China. And if you don't get a lot done prior to November 1st, you don't tend to get a lot done overall. So again, demand is the concern. And I think that along with probably higher acres in 2026, we want to start to entertain hedges. I mean, if we can get soybean futures, call it NOV 26, January 27, to $11, I think that there's a lot of value in those contracts. So already we are, a full 55 million bushels lower than USDA on 25-26 U.S. soybean exports. A little higher on yield. Both of those things kind of spill into end stock. So it's not an oversupplied market, but 400 million bushels with nowhere to go. Still about a 950, 1050 market. If we were to shift 5 or 6 million acres into the balance sheet next year, let's assume trends in demand, limited export growth because South America will produce, ever more soybeans every year. You're kind of getting stocks to 550 million bushels in 2026, 27. That is a $9 to $9.50 market. So again, thinking about if you're a soybean grower, entertaining, extended hedges. It's not so much 25 that we're worried about, but it's the 26 crop year. I think that if there's not a disruption to this, it could get pretty ugly pretty fast. And also kind of lastly, with respect to U.S.-China, this is still scheduled to begin, the vessel tax. It is a tax of $50 per net ton on the arriving vessel if it is a Chinese-made or Chinese-flagged vessel. Cargoes, container ships only. So it's not a huge deal for agricultural trade. Those are really bulk grain cargoes. Those are exempt. but some soybean meal, some lesser products, consumer goods. We think this is going to be a big deal for world trade as a whole, and kind of something that's flown onto the radar. I mean, this is a pretty sizable tax on Chinese vessels, and again, those are the majority of seagoing vessels on Earth today. $50 per ton, and this is scheduled to start, October 14th of this year. And so if that doesn't change, we're kind of prepared for some more macro market disruptions if this is not changed. And with respect to kind of food demand globally, wheat's been the thing that we're, through in deeper into the new crop marketing year than others. And if this is kind of a proxy for general ag demand, it's something else that starts to ring alarm bells. And we've said this before on the signal, but trade is the best indicator of actual demand because we're not estimating residual disappearance or feed use in Europe or China, which is impossible to know. But we can count the exact number of tons on a vessel, where it's coming from, what's on it, where it's going. We add all those up, and that's where we come up with these charts. World wheat trade to date is down about 10% from last year. And in August, the combined major exporters shipped just 13.7 million tons of wheat. That was down 15% from last year. Typically, the August-October period's pretty big time for world wheat trade, and we're already starting to miss that. So the wheat market seems to be telling us something. I mean, just think about earlier this week, $4.98 Chicago wheat. It's supposed to be in the process of bottoming now, and maybe it is, but the recovery is on the other side of this. You don't have demand growth in a major food commodity. That's something that's concerning to us. And kind of lastly, we kind of think about what's on the other side of harvest. Again, as we debate whether December corn has scored its low, how low is low, how big is big in terms of U.S. crop sizes. Would you know that to be bullish of feed markets, you've got to have a weather problem or a Chinese trade deal? I think the Chinese trade deal, while possible, is still some 6 months away. Lots of things to fine tune there. Weather-wise, again, it's far too early to be concerned or adjust any of your South American production estimates. But for what we know now, it seems like things might be pretty good or at least normal. And so neither La Nina or El Nino is expected between now and January 2026. If you isolate those years are years that typically Southern Hemisphere weather, especially in Argentina and Australia, does pretty well. Usually have trend or above crop yields in those years where it's kind of a year of no Nina. On the left, last week, you've got the International Research Institute's latest and greatest precip probability forecast for South America from September to November. So this will kind of cover the entirety of South America's planting season, early reproduction in parts of Argentina, northern Brazil. And you can see here that any dryness should be kind of confined to Uruguay and far southern Brazil, which aren't major producers. Most of the South American ag belt slated to get abundant rainfall. And why I think that's important, what's jumped out to me this week as we look at on the right, that is actual gauge measured rainfall in South America since Sunday night. And so an inch to up to 4.5 inches of rain has fallen across, Uruguay, southern Brazil, and most of Argentina's ag belt, which is circled. So these seem to be aligned at the moment. And I guess all we can say for now is that once, early corn and soybean planting starts in Argentina, kind of the last week of September, probably no water issues, no drought present. Does that foreshadow, the graphic you see on the left, just kind of normal to abundant rainfall during our autumn months in South America? And Australia is forecast to be very wet during the entirety of their canola and wheat growing seasons. And so, you can't pay too much attention to the details of these 90-day forecasts, but similar to South America, this is rainfall, gauge measured rainfall in Australia since Sunday night. You can see that, half of an inch to up to, 1.5, 1.6 inches in a lot of Australia's ag belt. That's what's circled here down the graphic on the right. So it's actually quite wet for Australia in August. So it does seem like these forecasts so far are verifying. And again, that matters because if you fast forward 90 days or 150 days and we have avoided problems in the Southern Hemisphere, we most likely will be building stocks of feed. This is what this kind of looks like if there are no problems in South America. You're adding another 6 million tons to major crop production, a newer record. Do we sort out issues with China, or can Brazil and Argentina, maybe for the first time, supply the entirety of China's soybean needs starting February of 2026. That is at least one of the risks in the marketplace. So we spent the hour talking about a lot of things, probably too many things, but this is the high level advice and recommendations that we've got. So one, even December corn's rally today, kind of accounting for seasonal trends already. Maybe the corn market's bottomed, but this is the time of the year to buy corn, not sell corn. I think you're in the process of forging lows. Again, whether it's here, 10 cents below the market, debate may not even be worth having. But if you're a dairy operation, you want to buy corn prior to October. You also want to hedge your forward milk production, prior to probably October 1st or October 15th. So that's basically the time we're in now, is you want to start hedging, selling milk, buying feed. That's something that we do recommend. Take some of this risk off the table. So if there's nothing else, I think we want to communicate this phenomenon, that this is the time of year to start very, very seriously entertaining locking in at least milk to feed ratios. So I'm sure the next 2 weeks will be full of excitement. We'll have new yield data to talk about, and we'll have a lot more dairy data to talk about as well. But for now, that is kind of it. If you have any questions about anything today or later, my email address is here. Do not hesitate to reach out. Thank you so much.
Awesome. Well, thank you, Ben, for sharing your expertise, and thank you to our audience for joining us here today on the Dairy Signal. Before we wrap up, I just wanted to again thank Ben, but I also want to highlight next week, professional dairy producers will also be hosting our ACE Twilight meetings across Wisconsin. These programs are a great way to connect with farmers and community members and elected officials, and a great way to start conversations about water, land, and dairy's role in our communities. So we'd love to see you guys at one of these gatherings, but you can find the full schedule and details at pdpw.org. But if you'd like to rewatch today's episode of the Dairy Signal and share it with your team, you can also find the recording and other resources on our website. But we hope to see you next week on the Dairy Signal, and bye for now.